Hello, everybody. It's Dave Robles with Think Real Estate. I am bringing to you a really important conversation with Andy Green. He is a senior loan officer with Capital Mortgage Services. And we're going to talk about loans because, man, in the last year, rates have come down over a point. And for the first time, mortgages are being spoken of in a positive sense. Okay. And buyers are coming back into the market in large numbers. And I really want you, if you're a buyer, to understand what's going on. And if you're a seller, learning about some options that will help you maybe buy and sell at the same time. So, Andy, welcome, my friend.
Been working together a long time.
Yes, we have. Andy is a 25-year veteran in the mortgage industry, but just as importantly, a friend of mine, and he's been doing our loans here at Think Real Estate for over 15 years. There isn't a question he doesn't know the answer to. And we have leaned on him for all those 15 years as a resource when it comes to mortgages. So let's get started in here and get right into it. Andy, in one sentence, is now a good time to buy?
Well, absolutely.
Okay.
We're seeing rates have come down, so affordability's increased. With the increased affordability, we've seen increased demand, and as we're starting to see multiple offers. I think we're going to continue to see that. We're going to see more demand, which is going to put upward pressure on home prices. So, long story short, you can always refinance to a lower rate if rates go down further, but you can't go back and buy the house for a lower price.
Wow. Well said. Okay, cool. What do you think the biggest myth people have about mortgages today?
There's a few of them. I mean, a big one is people think they need a large down payment, which is not the case. I mean, ideally, you can buy a place with 3.5% down. In certain, if you're a veteran, you can buy a place with 0% down. I think that's probably the biggest myth. But the other one is waiting for the right time to buy, which we just covered.
Yeah, I love something I've heard over the years is you don't wait to buy real estate, you buy real estate and wait.
Yes,
You know,
because real estate has gone up, if I remember correctly, 78 of the last 84 years.
that's a pretty good track record.
It's not bad.
Yeah. So, what do you think is the number one mistake that buyers make when they're getting a mortgage?
Well, I think the biggest problem buyers make is they don't get pre-approved. I mean, I think they start going out and looking for property, and then they go and talk to a realtor, and they start, trying to figure out where their price went, but they have no idea. I mean, you got to talk to a lender. You got to get pre-approved. I mean, that's the first and foremost.
Yeah, that's true. That's true.
Okay.
So we're going to get back. Okay. Let's answer that question one more time. What do you think the number one mistake is that buyers make when they're getting a mortgage?
Well, we're getting a mortgage. First off, a lot of buyers they don't get pre-approved. I mean, they go out looking for property, or they go talk to a realtor before they're pre-approved, and they have no idea what they're qualified for. A lot of times, sometimes they think they're qualified for more than they are, and a lot of times they don't think they qualify for as much as they actually qualify for. People
Yeah.
are shocked a lot of times, and the other mistake they make, I think, is not educating themselves. I mean, talk to a professional and learn a little bit about mortgages so you're well versed and you can make an educated decision as opposed to just kind of following along with what someone tells you.
Yeah, I agree. I always tell clients, if you don't go to the bank and get the loan, there are dozens and dozens, maybe more programs, different loan programs for different borrower needs. And people think that it's kind of a one size fit all, but it is so far from that. Okay. So how early do you think a borrower or a buyer should actually speak to you or a lender?
And technically, this should be the first call they make when they're considering purchasing a property.
But what if they're not going to buy, like here we are, February 26th. They say, I'm not even going to buy a house until 27. Should they bother you?
Yeah, absolutely. I mean, let's have a conversation. First off, get some education and understand the process. Secondly, you may be prepared to buy something sooner than you realize. And lastly, you may be in a position where if you are planning to buy down the road, we can advise you what to do. So when the time does come, you're in a much better position and you put your best foot forward.
Yeah, I hear you. So, my office is here in Glendale and we kind of cover the Northeast LA area, Hollywood, Los Feliz, Highland Park, Pasadena. You work with agents and buyers who are buying all over Southern California.
Yeah, all over California and about 10 other states.
Wow. So we're seeing multiple offers here in my area. What are you seeing in the other parts of California, for example?
We're seeing the same thing. I mean, we're seeing an increase in multiple offers, but if the home is priced right, typically you're getting more than one offer. It's the houses that are overpriced and are sitting on the market for months at a time because everyone can look at it and just go, this price should be $1 million house and it's listed at 1.4. That house is going to sit. But for the most part, we're seeing multiple offers increase on properly priced properties.
Gotcha. Okay. Okay, cool. Now, there's a couple of terms that I really want people to understand. And I know the difference, but I want to hear from you. What is the difference between somebody being pre-qualified for a loan versus being pre-approved for a loan?
Okay. Yeah. Um, it's pretty simple. Pre-qualified is you have gone to a mortgage professional, hopefully licensed mortgage professional, and you have provided them with all of your income, your assets, and they viewed your credit report. And based on those items, they've determined that you're qualified to purchase a property for X number of dollars, assuming a down payment of Y. Okay. A pre-approval is you provide all the same documentation and it literally goes through the underwriting process and an underwriter gives you the stamp of approval. So you're basically guaranteed to get financing, period. On a pre-approval and a pre-qualification, it's only as good as the mortgage professional that you spoke with. And oftentimes people tell you you're pre-approved and you end up not being pre-approved. So it just depends on the quality of, lender that you're dealing with.
Yep. 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 I totally agree. To me, a pre-approval is something we can kind of take to the bank, no pun intended. But a pre-qual, I mean, more work needs to be done.
Pre-quals are utilized more than pre-approvals. But again, it's where you go. I mean, if you go to an online mortgage brokerage, Rocket or Zillow, I mean, not trying to talk bad about them, but they have a track record of pre-qualifying people. And then when they get into underwriting, they're no longer qualifying. The big banks, they have a similar reputation, unfortunately.
So let's talk rates real quick. What are the rates right now, today, just approximately?
5.06s.
Now, if someone can get a loan for like 6.25 today, 6.125, if someone's buying $1 million house, 20% down, what is that mortgage payment look like?
Just the round number, about
$4,500 a month. And that's not including interest and taxes. That's just their mortgage payment.
it does include interest. It doesn't include taxes or insurance.
Right. Taxes and insurance. Okay. So like I have clients who can get a loan right now for 6.25, but they tell me, Dave, when rates get down to 5.75, if they would drop a half a point, they would be all in. They'd be excited about buying a house. What's the difference in payment there? How much are they going to save if rates come down a half a point?
Going on a $800,000 loan, maybe $250 a month.
$250. So they're going to wait and save $250 a month, which is $3,000 a year. Meanwhile, we know that the lowering rates increases demand and it's going to increase houses. I know LA went up 6% last year in 2025. I'm expecting prices to go up that much or more this year with the lower rates. Do you see that as possible?
Well, I'll give you the gold standard for prognosticating appreciation, which is a company called Cotality. They used to be called CoreLogic. They changed their name recently, but the bottom line is they are the gold standard. That's who the industry looks at. And they produce a report every month, and it's a 12-month rolling report. So it's their prediction for the next 12 months. And for the last 3 months, it's increased each month over the last 3 months. Currently, it went from 4.3 last month to 4.5 this month. So there's expecting home prices to appreciate 4.5% over the next 12 months. Los Angeles and those types of areas are going to eclipse the national average. It's just the way it works. This is a national average, and it's all based on the fact that they're anticipating lower rates and more demand going forward this year.
So that $1 million house that you can buy today with a $4,500 mortgage payment in a year is probably going to cost you $1,060,000, $1,070,000.
Where
There is really no savings, and you're just ultimately costing yourself a lot of money because you're paying more for the house.
you're losing money. And then remember, you can always refinance to a lower rate if rates come down by the end of the year. If you bought now, if rates come down at the end, it's refinanced to a lower rate. You know, you can't go back and buy the house for a lower price. Doesn't work that way.
So what about adjustable rates? Are those a thing right now?
Not at the moment. I mean, they're great programs. We don't really have any straight adjustable rate mortgages that just literally adjust from day one. We have what's called hybrid ARMs, which is what the majority of everyone else out there has as well. It's fixed for 3, 5, 7, or 10 years. And after the fixed period, it turns to an adjustable rate mortgage. It's a great product, especially in a declining interest rate market, because you have 3, 5, 7, or 10 years of fixed rate before you have to worry about the rate changing. But right now, they're priced pretty much the same as a 30-year fixed, because the industry knows that rates are going to be coming down, and they don't really want to loan you money at 0.5% lower than the going rate, knowing that you're probably going to refinance that loan in a couple of months or 6, 8, 12 months anyway.
Yeah.
The 30-year
No
fixed loans are
longevity.
still, we're doing 95% of the loans we're doing are 30-year fixed loans. Currently, that could change, but currently that's what the secondary market is. That's where the loans are priced.
Gotcha. Okay. What do you think happens that causes loans to fall apart in the last minute, like at the end of the escrow?
Oh, shouldn't happen. Typically it's, honestly, typically it's either something that's unforeseen, buyer loses their job in the middle of escrow, or, it could be a mistake made. Anyone could make a mistake at some point, just anyone in the transaction. But for the most part, it's typically, it's due to subpar lenders is usually what the problem is. They usually start off saying, we're good, we're good, we're good. And then they get to the end and they go, oh, we're not good. We have a problem.
Yeah.
And sadly that happens, and it shouldn't happen. But again, just like any other industry, 20% of us do 80% of the business because 80% of us aren't very good at it.
So real quick though, you mentioned something I think is kind of relevant, is what happens if someone loses their job? Like in the middle of the escrow, they lose their job, they're able to maybe find another one, but how does that affect the process?
Well, if we need, let's just say it's a husband and wife who are buying a property and they both work. Okay. And let's say the husband loses his job. Okay. Just doesn't matter. Just as an example, if we can still qualify with just the wife's income, then no harm, no foul. But if they don't qualify any longer, then we have a problem. Now, if the client can get a job before the close of escrow and it's in the same line of work, and if it's, a W-2 employee to a W-2 employee, then that's fine. We can, once we get the first pay stub from his new job, we can fund the new loan. But there's other things we can do in that situation. Let's just say hypothetically that did happen. Maybe they go to a family member and get them to co-sign, and we can add the co-signer on. So now they qualify with the co-signer's income. And then, the person can get a job down the road, but it doesn't affect our loan at that moment because we're using the co-signer instead. So just different ways of looking at things, trying to be creative and think outside the box to make sure we get to the finish line.
Yeah, that's great. Good to know. You always got a solution. Yeah, what we're doing, man, on both sides of this is solving problems along the road.
Yes,
How risky do you think buying a property with the smaller down payment is?
risky at all. Again, you're leveraging the least amount of your own money. So
Not for the seller. Is it riskier for the seller?
I would say minimally. Technically it would be, if you have more skin in the game, it's easier to get a loan approved. But, if you're putting down less than 20%, the mortgage is going to have mortgage insurance, and that protects the lender. So the lender is less likely to have an issue approving you because they have protection on the back end if you default on the loan. So from a seller standpoint, really not. A lot of sellers or agents seem to think FHA is not as good as conventional. When it comes to financing, it seems to be it's more risky, which I don't believe that's the case. The only issue I can think of is FHA has an issue with peeling paint. If there's peeling paint on the property, it has to be fixed prior to closing. But other than that, they don't really have much different requirements than a conventional loan. So I have no issue with FHA. I think FHA is a great product. Same with VA. But yeah, down payment is really not an issue, not in today's market at all.
Yeah. I mean, my wife and I bought our first property with an FHA loan. So
Yeah, most people did.
it's a really great product. A lot of LA buyers, people here in California, they're self-employed or they work in the industry or whatever, or they get 1099 employees. How does that affect their buying ability?
That's a good question. There's many different ways that people get paid. A lot of people in the industry, which we deal with a lot of those people in our area, they have some W-2 income and they have some 1099 income. They might have a corporation or they get some paid W-2. It's just how the industry works. If you're familiar with how to process those loans and how to qualify those people, it's not a big deal. But a lot of banks and a lot of lenders have difficulty with it because they don't understand it. And if you're just straight self-employed, a lot of self-employed individuals don't show a lot of income on their tax returns. So a lot of lenders will look at it and say, well, you don't qualify for a mortgage loan because we have to qualify you based on your tax returns, which is true. But there are so many alternative programs out there for self-employed people that we use on a daily basis that eliminate the need for that. Like we do loans that you qualify simply on your bank statements. Take your business bank statements and we use your bank deposits to qualify you minus what percentage for potential expenses. And I have a client who I'm doing a loan for right now, and he had about $12,000 a month of income on his tax returns that we could use, but that didn't get him to where he needed to go. So we got 12 months worth of his business bank statements, and now I have $365,000 a month I can use to qualify him because he runs a ton of money through his business. Now he qualifies hands, slam dunk. And the difference in the interest rate between the two was 1/8%. That was it. So lots of things we can do. We have a loan we call a DSCR loan, debt service credit ratio loan. So as long as you put down enough money that the property cash flow is based on the rental income, you get a loan.
Is that for 5 units and more, or like even 4 and under?
That's for 1 unit.
Any investment property. If you're
Any
buying a
investment.
duplex, as long as you put down enough down payment.
Duplex.
Wow.
Yeah, a condo, whatever. As long as it cash flows based on your principal, interest, taxes, insurance, and potential HOA, whatever the monthly expenses for owning that property, let's say it's $5,000. Okay. As long as your new mortgage payment is going to be lower than $5,000, you get a loan.
So, wow. So how does that, like, let's say you're buying a fourplex and it cash flows almost entirely just at the asking price with 5% down. You can get a loan with 5% down.
Yeah, well, DSCR loans, the minimum down payment is 10%, but again, you're not going to cash flow with 10% down. Most likely, it's pretty unlikely that you would cash flow in this market. But if you were to put down, you might need 20-25% to get that to cash flow based on the rental income. We have to do an appraisal, have to do a rental survey to determine what the rents are, unless we have lease agreements in place and their tenants are remaining in place. But one way or the other, we come up with the rental figure. And as long as the mortgage payment, including taxes and insurance broken down monthly, is lower than the rental amount, you get a loan.
Wow. That's really great to know. Thank you.
Yeah. And we have more products that we have, but I'll spare the time. But I mean, if you want to reach out to me, we do loans on profit and loss statements you qualify on. So there's all kinds of different stuff we can do.
That's great. That's the kind of creativity that it takes for a lot of our buyers to find in order to help them get into a house. Because we all fit into that nice little box that, Chase or Bank of America expects you to before they will give you a loan. So
that was what I was going to make. They don't offer those types of loans that I was just mentioning, nor does your local credit union, nor does Rocket Mortgage or Zillow Home Loans or any of these online companies. They don't offer these programs.
Yeah. So what about just switching gears a little bit? So many houses these days come with ADUs. How does an ADU affect the buying process for you?
These are awesome. I mean, as long as it's a permitted ADU, first off, when you're buying the property, you can use the proposed rental income from that ADU to help you qualify if you need it. Secondly, it provides additional value. It makes the house more valuable when you go to
Will the appraiser use the new added on square footage if it's permitted as part of their
100%. And it's going to be better for resale too, because it's going to increase your buyer pool. Because, tons of people would love to have potential income revenue from their property. Just, they're going to live in it anyway. If they can generate some revenue, that's wonderful. Or maybe they have an elderly parent or teenager that they want to utilize that space for. I mean, it just makes the property more desirable.
Yeah. Okay, good to know. Do lenders view new construction homes any differently than our 80, 90-year-old inventory? No, it's all the same.
As long as, again, if there's a defect with the property called out by an appraiser, then we'd have to address it. Typically on a newer home, you'd have less of that than you would on a resale. But I mean, you've been doing this long enough. We don't have many issues called out by an appraiser. Very rare that we have
Yeah.
on resale properties. So almost zero difference.
So we've been talking so much about buyers getting a loan. Let's pivot a little bit, talk about homeowners. We've got clients who they bought their house 20 years ago and now they're in a situation where they want to sell and buy.
Okay.
And sometimes they can't because their down payment for their purchase is wrapped up in their home. How do you help these people?
Oh, we actually do this all the time. We offer bridge loans. We do them in-house. So let's say you have a property that you want to sell, and I'm just going to use round numbers to make it easy. Let's say it's worth $1 million. And let's say you owe $200,000 on that property. We'll loan you up to 80% of the equity. So 800,000 minus the 200,000 that you currently owe. So we'll loan you $600,000, and you can utilize that $600 to use that for a down payment on your new purchase. And then as soon as you sell your $1 million home, once that sells, it will pay off the 200,000 that you currently owe. It'll pay off the 600,000 that we loaned you. And then the balance of 200,000 will go to you as your proceeds. And now you have your new home prior to having to sell your current home. It also gives you the opportunity to fix your current home up if there's not, if you find something that you really want to buy, but your current home is not in, for sale condition yet, and you need to do a little work for it. You could use some of that money from the bridge loan to make some upgrades or, let's say you need a new roof or you needed to paint your house or something. You could utilize some of those funds to do that in the interim to get your house ready for sale.
Yeah, that's a big deal. We see so many clients and we've counseled them and helped them do this, but the as is price might be, $1 million for their home if they were to sell it without doing anything to it. But if they were to put in maybe 20 grand, 25 grand in some paint, some eyesore repairs, in some staging, that $1 million house is now $1,200,000 or $1,250,000. So that $25,000 in rehab work can be 10 times. You can get 10x out of that.
Oh, for sure.
Yeah. And you guys have the product that allows somebody to tap into that 25 grand if they don't have the ability to do it themselves.
Well, I'm chuckling over here because I'm thinking back to when you and I first started working together, and $1 million home was a mansion.
Yeah. Well, and you know what? 20 years from now, people are going to say, "Oh my God, you bought a house in 2026. You're a genius. That house is on, twice as much as it was back then." And we can't fathom that, but that is 100% what happens. And it goes back to when these houses were built in 1910. So that's wild for people to think about, but they need to think about that because the best time to buy a house was 20 years ago. And the second best time is always today. So don't get stuck in that belief that houses are too expensive, but they're just going to get more expensive. Okay.
Economy, everything goes up. But remember, so does incomes.
Yeah.
So if you buy a house today and you have a 30-year fixed mortgage, your mortgage payment is never going to go up. Might go down if you refinance, but it's never going to go up. But your income will most likely increase as your career continues. And therefore, with every passing year that your income increases, your mortgage gets that much easier to pay. So if you stretch a little to get in, you should be fine.
100% agreed. 100%. So what are some things that we haven't discussed that you think clients should know about? We covered a lot of ground.
Yeah, you're putting me on the spot here. I'm blanking.
I think we covered refi, equity lines, multi-units.
We didn't cover
Entertainment
equity lines.
people.
We didn't cover equity lines if you wanted to do that.
Yeah,
There's
of
also
course.
another alternative if somebody owns a home and they want to do some home improvements or they need money for debt consolidation or whatever reason. Let's say you have a $1 million home and you have a $500,000 loan on it and you need 150 grand. Well, it might not make sense right now to refinance to a new $650,000 loan to get you that 150 grand because if your interest rate's 3% right now, rates are higher than that. So it may make sense just to get you a second trust deed or a home equity line of credit that you could tap into to access that 150,000 if you needed it. Simple explanation.
Got it. All right. Good stuff. I think the bottom line here, what I want people to take away from this is there are options. If you are buying, if you are selling, if you need a loan to help you get into that house or get out of your current house and get into your next house, there are very creative options that are available to you. And now the rates are down in the low sixes, high fives. We're going to see a lot of activity. It's going to be a busy year for buyers. We're going to see a lot more sales take place, I think, in 26 than we did last year because people should not forget this. But as rates come down, homeowners who have felt tied into their house because of their 3% mortgage are going to start selling. And that's going to increase the number of sales that we have. It's going to help with options for buyers. They're going to have a few more houses to choose from, but there's also going to be competition because the rates did come down and they're going to be more buyers. So it's going to be a really interesting year. I highly recommend calling Andy if you have any questions about your purchase or about your sale. If you require money for that, call me if you want to talk strategy about what a purchase is going to look like, what a sale and a purchase is going to look like. And Andy, thank you so much for taking the time to chat with us. And if I need anything, I know where to go. Thanks, Andy.
Thanks for having me on. I appreciate it.
Okay, take care. Bye-bye.